I'm Hari. I'm going to be talking about GameStop today. If we're planning on participating in this sort of movement, we are obviously everybody's informed about what happened, what's happening now, what could happen later on. And also whoever's just watching on the sidelines, you are valid as well, whatever is going on, whether or not you're buying stocks or not stocks in this drama, it's all good. I'm going to go ahead and share my screen. All right, so again, GameStop and Wall Street bets. This is where all of this stuff comes from. And if it sounds like a meme, that's because it is a meme. Thus the subtitle, Your Guide to Time in Hands. And whether or not you know what this means, it's not really all that important. But now that we're talking about memes, let's talk about memes. These are some of the terms that are going to come up. And the reason I'm talking about something so silly as memes is because some of this stuff does have roots in the motivations of these people, the commenters, the people buying the stocks, quote unquote, retail investors. Some of these terms like smooth brain, apes together strong, blah, blah, blah. This is all very self-demeaning. They have all even more colorful terminology that's, it's just not polite to people with actual mental disabilities. But the point of all that, as I'm gathering it, as we read through some of these comments, is for these people to admit freely that they don't know what they're doing. A lot of what Wall Street bets is just a game. People's put in money that they're okay with losing, but then there's obviously people who are going to put in $1 million who have never done any financial research. We're going to lose it all. It's just part of the game. And for the longest time, that's what it really was. The term diamond hands is something important as well. This is an allusion to holding strong. You have strong hands versus paper hands, which means that you let things slide really quickly or you're whatever. So the term here is based on leading you to having strong hands. Hold your stocks no matter what happens. To the moon is just a meme. It's talking about how you're going to ride your Tesla on the moon because you made so much money today. Some of these little emoticons as well are, again, going back to that same thing, the diamond emoticon, the rocket emoticon. When you see this kind of thing, you'll be able to identify certain users on these websites who are familiar enough with the subreddit. And this is important because then you'll know that they've been paying attention long enough to not only see the memes, but understand the kind of information that's going on out there. It's just a self-identifying sort of thing. At the same time, if you keep going on that thread, you're talking about bull markets and bear markets, bananas to the roof. Some of these, especially that banana reference, is a very important post that went up a couple of days ago. Somebody who talked about very simply what the situation was, and they use this they use this analogy with monkeys and bananas and snakes. And the people who are paying attention will know that metaphor and to be able to keep up whenever somebody talks about it, because they're going to use a simple term like a banana rather than something complicated like shorts, longs, pulls, spreads, things like that. I mean, I'm going to go into that in a second, but it's also important to understand that this is a journey that people are taking together, whether or not it's in a serious fashion with your, super complicated financial portfolios, or if you're just playing a game, if you're doing a meme like this, it still means something to somebody somewhere out there. And this is why it matters. So who are the players and what's going on here? It may seem obvious, it may not be. There's Robinhood. Robinhood is an app that has allowed in the past couple of years people to trade without stocks and fees. In the past, people had to pay a lot of money just to be able to buy and sell single stocks, $25, $50. They had to pay a guy to have them on retainer. That's how it used to be. Back in the day, you had people on the floor yelling and screaming at one another who were paid by other people to sell shares of companies. Nowadays, you don't need to do that. It's all computers. It's all algorithms. It's all just a game. Melvin Capital is a hedge fund. It's a company that plays the game, and they play the game professionally. They have a lot of money. They've got funding for big groups from big people, just big dollar signs. And they play the risks. They have complicated algorithms. They have incredibly intelligent individuals who put together programs and spreadsheets and blah, blah, blah. They do all this in-depth analysis. And so they are really professionals in this environment. Citadel is another term you're going to hear thrown around. That's a company that's putting funding into Robinhood, which essentially just means that they have a stake in the company. And then Wall Street Bets, also shortened to WSB, is just, again, like I said, a group of people who want to just talk about memes, and they want to talk about they want to talk about stocks and things like that. It was just a game. And it kind of still is just a game until they came after the people who are investing, and they said that your investments, your efforts are not valid. So these are our players here. People from Wall Street Bets just kids like you and I mean, we're not kids, but just people with a little bit of money to play with, somebody who wants to get into investing, somebody who wants to learn about stocks, like I did 6 years ago now, you get into Robinhood. You don't pay any fees unless you mess up in your investing. If you spend money you don't have, if you don't pay them back when you buy stock, things like that. But in essence, you can go to this app and you can buy a stock of a company that's publicly traded. It became that simple. So millions of people signed up and they needed a resource. So they said, well, we're at Wall Street on Reddit because Reddit is well used. Then they got somehow sent to Wall Street Bets because who doesn't want to just play games and have fun and talk about memes? Robinhood, again, just going back a little bit, is funded by Citadel. Melvin Capital is a company that decided that it wanted to play a very risky game. And truth be told, it wasn't that terrible of an idea if you were just playing with the people who you've been playing for the past couple of years. These people played a game that wasn't really intelligent. Their risks that these people took were not sound, in essence. I mean, as of 2 weeks ago, it was a fantastic strategy, very sound. You take companies like Nokia, you take companies like AMC and Best Buy, these companies that are not able to pivot their business models fast enough, quick enough, bet well enough to keep up with today's market. Video games are being bought and sold online. You know, apps like Steam, you can get them directly from Microsoft. These other companies came in and stole business from GameStop, and GameStop wasn't able to adapt. Same thing with AMC. I mean, you just can't adapt to COVID. I mean, sure, you can go you can like Warner Brothers went to HBO and they said you can show our movies online. That's a form of adaptation, but AMC wasn't able to pick up on that. So these companies are failing because of some circumstances, bad management, bad business, blah blah blah. We can go into that if we want, but that's not what the situation is. Hedge funds like Melvin Capital made a bet where that these companies are going to fail in using a complicated term called a short. We can go into that in a second. And they made a good bet. People on Wall Street Bets looked at this and they said, okay, well, we can exploit this mistake. They've got a risk that they shouldn't have taken, and let's just press. So did I miss a slide? No, I didn't. All right, so where did all of this start? There's this guy named Deep Effing Values. He is kind of sort of an intelligent guy. He was featured on Wall Street Journal. He's just somebody who pays attention. And as people who pay attention, he had things to say. He had opinions to give. Since back in 2019, he's been talking about GameStop. If you go to this guy's profile, he's posted a lot of times why GameStop should be something you should be investing in for one reason or another. He's the guy who put out this information about Wall Street and this and that. He's the guy who said, hey, this is something you should be doing, and this is how we can make money. Wall Street Bet as a collective, all these people who were hanging out there took this risk and they capitalized on it. These hedge funds like Melvin Capital, all like I said earlier, they were betting that these guys would fail. What was unreasonable about their bet is that they were going at least 120%, 140% risks on their types of stock, on their types of contracts and orders that they're placing in the stock market. This is a very high risk. If we're talking about you and I taking a risk, we wouldn't say, hey, if there's a 100% chance, if there's a fairly high chance of me getting hit by a car by running out in the snow, I wouldn't do that. Now, I'm not saying that the risk was 120% risk. I'm not saying that they were risking everything. This is just a bit of a term here where they were placing orders on 120% of all available stocks, something like that. And again, Wall Street Bet, people like you and I who didn't have the money to pay somebody like a fiduciary or something like that, who didn't know about index funds and mutual funds, just decided to go on Robinhood or some other free app. We pressed on this mistake. And when we did that, big hedge funds started to lose money. And then they freaked out. When they freaked out, the guys who had the money talked to the people who were running the show, like Robinhood. There's a slide missing. Well, that's what happened. Stop here for a second. Wall Street Bet tried exploiting this mistake, and that's when things went down. So let's backtrack for just a second. Let's talk about some terms. I know that Stephen has gone into quite a bit of these in his spread 11. Some of the basics he did go into. So I'm not going to go super duper deep in depth here, but just for people who don't know or somebody who just needs a refresher, our portfolio is just it's a group of investments that you make. They can just be stocks. They can be ETFs. They can also be real estate. You can be investing in something like collectibles. It's not a good idea, but you can. technically it's all part of your portfolio. A return is how much you make money on top of your investment. It's usually expressed as a percentage or a dollar amount. As you look at the image there, this individual has 67.87% return on his investment. That's what that is. Stocks, as you know, are parts of a company that you can buy and sell at no ownership. Retail traders is a newer term that even I didn't know up until last week. It's just a way to describe that individuals who don't have, it's just a way to describe individuals who don't have brokerages, they don't have professional resources, they don't have a fiduciary, they're not licensed, and they're not trained, blah, blah, blah. Somebody like me who just downloaded the app and started reading articles and said, oh, well, that's what that is. Retail traders, for the most part, comprise of almost all of Wall Street bets. They're just everyday people who are trying to make them a little bit of money. Now, longs and shorts are also a little bit something new. It's more of like a technical term in the industry. Long is your traditional buying and selling of a stock. Stephen talks about this in his spread as well. I think there's a timestamp in the comments of this presentation you can go to later on. Essentially, you buy a share of a company. You say, well, I think AMC, or let's not say AMC, let's say Tesla is going to do really well. So I'm going to buy one share of Tesla. You place an order on the market and you buy the stock. That is, in essence, a long. A short is the opposite of a stock trade, in which case, backtracking just a second, you're buying a Tesla stock because you believe that Tesla as a company is going to do well. You believe that Tesla as a company is going to make money, he's going to pay you dividends, this, that, the value of this company is going to rise. So when you buy a stock today, 10 days down the line, when you sell it again, you'll make a little bit of extra money on top of that. It's just a simple concept. But what if we looked at it the opposite way? A short is a bet that a company is going to do badly. So just our example, Gamestop. It's a failing company who wasn't able to adapt to the internet. It's a company whose business model failed pretty quickly when people just realized they didn't care about selling their games. They could just get rid of them. Something. GameStop wasn't a viable business model. They spent money on all the wrong places and they didn't adapt quickly enough. So it's a bad company, and so it fails, and that makes sense. So what some people like these hedge funds did is they bet that this company will fail. And that's what a short is. Essentially, what you're doing is you're borrowing a stock with the promise that you'll just give it back later on. You type up some sort of complicated contract or agreement that says that, hey, if I don't give back your stock, I'll pay you this, and that penalty. There's interest, blah, blah, blah. That's all technical. I'm not going to go super duper into the technical bits because that's not what's important to people like us. What's important is that companies like Melvin, this guy named Melvin, his name is Melvin. They took out these bets, these shorts. That said, okay, well, GameStop's going to fail, but they took out 120% of all available GameStop stocks. They said that we are going to bet this many stocks. We're going to borrow that many number of stocks so that later on when the company fails, we'll have bought them at a higher price, borrowed them and sold them at a higher price, and we buy them back, it was at a lower price. You net the difference there. Now, to talk about that banana analogy and the snake analogy, this is a very dumb way of looking at it. And I'm not saying it's a bad way of looking at it. It's just a very simplified way. Monkey has banana. Snake borrows banana from monkey. Snake has banana. Snake sells banana to chimpanzee for $10. Now, snake has $10 bill, but no banana. The bet here was that when the snake goes back to buy the banana from the chimpanzee, he's going to be able to buy it back for $5 because the banana's gone bad. So that's what happens. Snake goes to the chimpanzee, he exchanges the $10 bill and he gets the banana and a $5 bill. Then the snake goes back to the monkey and he gives him back the banana. Snake is left with $5 that he didn't have before. That's what a short is. The bet that the banana is going to go bad, the bet that the banana is going to be cheaper to buy later on, a bet that the company is going to fail. But what if you borrowed 20 bananas, but there's only 10 bananas available? The snake gave the banana to the chimpanzee and he kept trading that back and forth, blah, 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 complicated until you've traded 120% of all bananas in the world. That's not a good idea in any scenario. And in fact, the SEC, the government bodies are supposed to monitor this stuff and step in and say, hey, this is not okay. Stop taking these undue risks, blah, blah, blah. There was somebody who was out there who was supposed to say, hey, don't do that. 120% is not a good investment. That's not a good short. They didn't do it. Melvin Capital made a mistake. Wall Street Bet went after it. Now, a squeeze is another term where now the snake has to give back this banana to the monkey. But now the banana is $20 and the snake has no money. He only has $10, for example. The chimpanzee is trying to sell the banana at $20. Snake owes banana to monkey. As simple as that. But snake only has $10. So what does he do? He has to find a way to buy back that $20 banana, no matter what, and give it to the monkey. That's the contract. That's the agreement. That is the risk. So a squeeze is a term where we're talking about these stocks that go up in price where you bet that they wouldn't. So a squeeze in practicality is GameStop being bought quite a bit. The demand drives up, the price goes up. That's simple economics. So it went from $15 to $60. Now, even in that image you're seeing, it's $312. That's a lot more money. So if you were Mellon Capital and your short was, hey, I bought the stock at 50, now it's at 16. When I buy it back, I'll net the profit between the 50 and the 16. That was a short. Now you're in trouble because you bought it for $50. You didn't just buy one stock. You bought millions of stocks at $50. You multiply that across, and now the asking price is 312, and you're in big, big trouble. And this is where the trouble is coming for these big financial institutions. They made a bad decision. They took a bad risk, and now they're having to pay the price because somebody realized and somebody told everybody else, and now everybody else is trying to cash in on this. Now, what happens at this point is that contractually, these companies are obligated to buy back stocks to give them back to who they borrowed them from. The people who own them, people like you and I, can ask any price we want because we realize what they have to do. So we're driving up the price. And that's what a squeeze is. Now, gamma squeeze, delta squeeze are very minute little details. And I mention them here because you'll hear these terms getting thrown around. All it really comes down to is that price of this stock is going to go higher and higher because these hedge funds have a higher and higher demand for these stocks. They need these stocks. There's just no other question. They need these stocks back contractually. That's where the squeeze comes from. So when you hear people talking about going to the moon, 10,000 whatever dollars for the stock, it might actually happen. You might have a squeeze that high. And then theoretically, you're looking at an infinite squeeze. Even if there's one person out there who will not sell you his GameStop stock, but you are contractually obligated to buy it and give it to somebody else, whoever has the last remaining GameStop stock can sell it at any asking price because legally this other guy has to buy it back. Theoretically, I mean, I'm telling you right now, that's probably not going to happen. We may see $10,000, and at that moment, I mean, I'm telling you, we're going into history books. Like, there's going to be entire history books written about that $10,000 stock. Probably won't happen. So now that we have some of these terms kind of defined, I hope simply enough, let's talk about what happened. Well, before I talk about what happened, does anybody have any questions? Feel free to unmute or to put it in the chat.
I actually have a question. How is it possible to take a risk of 120%? Like, how can you do it for more shares than are available? Unless I'm understanding that incorrectly.
That's a great question. I know that that's a little bit misleading, and I put it in there as 120% risk because that's how some people talk about it. So when you see it in the wild, I want you to be able to identify that. And you're right, it's kind of misleading. It's not 120% risk. It means that, simplifying it to a world where there's, monkey, snake, and chimpanzee. And in that world, there's only 3 bananas. And then because of some circumstances, everybody doesn't know who has what banana. So monkey gives banana 1, 2, and 3 to the snake. Snake then sells bananas 1, 2, and 3 to the ape. And then you do this transaction of the shorting, where you keep selling it at a lower price, promising to give it back to somebody else over and over again between just these 3 players. And they don't realize that they're playing the game amongst themselves. So they keep saying, hey, let me borrow your banana. I'm going to sell it to that guy, and I'm going to buy it back at a lower price. I'll just give you back the banana. This little bit of the analogy, I'm actually having a hard time explaining properly, not just because it's hard to explain, but just because, I mean, how do you explain this idiocy? Basically, amongst themselves, they kept borrowing the same stock from each other and saying, hey, I'm going to give it back to you later, betting over and over again that when they go back to buy it, they'll buy it at a lower price. And so if there were only 3 bananas in the entire world and these 3 players traded the banana each 2 times each, That's 200% of a short is the technical term. Let's see.
Gotcha. Okay. So I didn't understand that they were the same three players. So that clears it up, actually.
Yeah, yeah. I mean, in our world, you can extrapolate it to mathematical infinite. We're talking about 8 billion people in the world. Everybody who technically can play in the stock market. There is a finite number of people who actually do. And so the analogy still holds if you take down the orders of magnitude. There's a finite number of players and a finite number of stocks. Those finite number of players are trading that stock amongst themselves, promising to return it, but even if they don't have the capability of doing it or something like that. And then the person who's left with the banana at the end of the day says, hey, I realize what's happening. You owe him a banana, he owes him a banana, he owes him a banana. I have the only few bananas left in the world. There's only 3 of them. So I'm going to sell that whatever the price I can sell it at, in which case you have a squeeze. Let's see. Natalie says, in a way, isn't this a giant prisoner's dilemma? I'm sorry to say, I don't know what a prisoner's dilemma is.
I'm not really sure how to explain it because it's like an econ lesson, but basically it seems like people are kind of at a stalemate because this whole thing only works if everyone holds, it seems. So it's kind of like who's going to cave first, because it can't keep escalating forever. Like after a point, everyone's like, oh, GameStop's at like $1,000. Let's sell. But then, so it's like, but then they're also kind of see who breaks first in a way. Is what I'm trying to say.
Yeah. I'm sorry, you're actually getting a little ahead of the program of the presentation here, but I actually do answer that question. I don't really know that the prisoner's dilemma is, but I'll look into it in a bit. I also realized that I go back and ask, hey, Karishma, did I answer your question? Are you good? I'm going to assume so. ATL says, what's the incentive for a stock lender to lend the stocks for shorts? Interest, actually. That's a risk that you can take. ATL is Anna. That makes sense. Anna Liang. It's a risk, and you promise. There's certain contractual terms that you set in, right? I mean, you're right. I mean, yeah, it's not just I'll let you borrow the stock for no reason. It's I'll let you borrow the stock, but when you give it back, give me $5 as well. It's a sort of interest that you can get on top of just this borrowing. So instead of looking at it as a stock, let's look at it as a financial sum. If I let Steven borrow $20, I won't just let him borrow $20. I'll say, hey, you can borrow it for $20 plus 1% interest a day. And so Steven will say, okay, yeah, that's no problem. I just need it for 1 day. So he'll buy, he'll borrow my $20. He'll come back the next day with $20 plus 1% interest. That's one way of doing it. I'm telling you, it gets more complicated than this. These people play games that only they know how to play. All right. And I mean, this gets really deep, but the essence of it are these few concepts of the shorts and buying and selling of stocks and the demand that goes up nearly infinitely. And Natalie's right. At one point, it might have to end, but what's the end game? We'll get to that in a second. And what's the interest rate for shorters who borrow? I don't know. It's just arbitrary. It's amongst the different people. Just the way I'll tell Steven, you can borrow my $20 for 1% interest. I'll tell Carmen, you can borrow my $20, but you have to give me a flat $5 back. Now, here's a key thing about short that I realized I didn't mention. The reason that the Friday that just passed was super important, and why these people went so hard and they did so many illegal things is because on Friday, a lot of these people had to close out their shorts. This was a financial and contractual agreement that said, hey, on this date, on this year, I will give you back the stocks that I borrowed, plus the interest or whatever other agreements we had. So you are contractually binding yourself to this date. You're saying at this time, I'll give you back your money. Steven says, hey, I'll borrow your money on a Monday. I'll give it back to you on Friday plus interest. So again, going back to the monkey banana analogy, the snake tells the monkey, I'll give you back your banana on Friday. And so no matter what, he has to give that banana back on Friday. That was a big thing there. So that's why you can have infinite demand, because at some point, the people who took out these short contracts, they have to go back and pay back. They have to go find those stocks at a certain time, at a certain date, at the end of this cycle, at the end of the contract. This is what we're waiting for as Wall Street investors. We're waiting for these people to have to close out their shorts contractually. At that point, they'll have to pay through the nose, no matter what asking price we offer them.
Can I add to Anna's question?
Yes, absolutely.
I find it easier to understand the incentives when we talk about the opposite of shorts, which are calls, bets that the share price will gain in value. Anna asked, what is the incentive for writing these contracts? The incentive is that if I sell, for example, last year, that user Deep Effing Value, he was buying calls of GameStop saying that by January 2021 or by April 2021, the share of GameStop will hit $12, $50. He bought those calls, and people. This guy's an idiot. Sorry, can you hear me? I'm on the road. Sorry.
We can sort of hear you. The last thing I heard was he's an idiot, and I'm like, yeah, you're right. He is. Who is he?
Yeah. So Deep Effing Value was going around buying these calls, which is saying, "Hey, I think GameStop's going to be worth that much by this time," and people sold him that contract. He had to pay money for that option. That's why it's called options. He had to pay a premium, whatever it was. Probably wasn't that much money at the time. And people sold it to him because they thought it was free money. At that time, they thought in January 2021, GameStop is going to be not that amount, way less than that amount. So they would sell it to him. And so on the other side of Melvin Capital's bets was somebody that sold him that option. And that's the incentive to being on the other side of that, if that answers your question, Anna.
Yeah, Stephen makes a good point. There's a lot of aspects to this issue here. I'm tackling it from one aspect. Stephen's is actually also 100% accurate as well. I also forgot that I had a whole quiz that I set up. If you guys don't mind going to the link that I posted in the chat, the first question for the slide there asks, just as a mic check, what's your favorite meme that I talked about? You don't have to answer if you don't want to. Let's see. Okay, so before I go on to what happened here, let's talk about also one more thing I'd like you to answer is the next section, slide 5. The question is, are you familiar with these terms already? And that's just it. Are you familiar with the terms already? And then just a quick question. I've never been in charge of a Zoom meeting. Is my screen still being shared here?
Yep, I see your slides.
And are you seeing my questions now?
Now I see your questions.
Yeah, okay. All right, so we did the terms. I hope you answered the question on the quiz thing. So let's talk about what happened here. At one point, GameStop had a change in leadership. They brought in this guy who was good at being able to pivot companies to the internet. That was what really sparked interest in this after all this time that Deep Effing Value was talking about, hey, go buy the stock, blah, blah, blah. They had a change in leadership. At this point, we believed that, yeah, he might be right. So we went out and we bought, and we bought, and we bought, and the meme was popular, and we bought. And that's when these people got in trouble because this stock jumped overnight. I remember this post on Monday where he was talking about, hey, you should go buy GameStop. And I saw all these emoticons. I was like, this is just a joke. I'm not paying attention. And then a day later, I'm looking at my Robinhood as well. I'm like, well, this is crazy. GameStop is jumping. I probably should have jumped on this earlier. It's not a bad decision that I didn't. When this happened, these hedge funds and all these people who were betting that GameStop would fail panicked. So they went and talked to their dad. They talked to their, whoever else is playing the game with them, the 1%ers. They panicked. And so what happened next is the people who were funding Robinhood said, hey, you got to figure this out. Your retail investors are screwing us over. Robinhood, this company that was supposed to support everybody, who said, let the people trade, blah, 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 power back to the people. they went against their title and they said, hey, you actually can't trade anymore because their excuse was that everybody was making a mistake by buying and selling the stock over and over again. In reality, it really was. They were screwing over these hedge funds. The hedge funds didn't like it. Robinhood was like, don't do that, blah, blah, blah. Their excuse was everybody's making a bad purchase. You're not making good financial decisions. We're not going to let you trade anymore. And that was at the moment that people got pissed off. Because what happens at this point is that people like you and me, we only put in like $200 into the stock and now it's 300 and something bucks. That's $100 we didn't have yesterday that we would really like to have. So we can go out and buy things and stimulate the economy in essence, or we can save it, or we can do something like pay our medical bills, or as people are doing, people are donating to hospitals and they're buying people food. They're doing good things with this money. They're throwing it right back into the economy. I mean, I'm biased here, but what happened is that Robinhood first shut down trading, and then on Friday they said then they said you can only sell your stock, you can't buy it. So they tried stimulating certain environments where they said, hey, you can't buy any more stocks. So then they said you can only buy one of them a day, things like that. They pulled out all these tricks, and a lot of these are not okay. Some of these are technically borderline illegal. You may have seen an interview with Chris Cuomo and the CEO of Robinhood, where he basically tears apart the CEO. He's like, well, tell me why you did this. Who's telling you should do this? I want you to start name dropping people in the government and in these institutions, line by line. Tell me contractually why you weren't allowing people to trade. This was really messed up because this was limiting people, everyday people's ability to make money off the stock market, which we were always promised that we could do. And so I know I'm not giving a very technical presentation here, and that's not what I was trying to do, because anybody can go out and do this financial information research. But what really matters is the principle of this scenario, because that's what it was. It started off as a meme. It turned into this actual financial transaction. And then when they decided that we can't make money as well, it turned into something else. So then Wall Street decided to go to war with Reddit. And they didn't just decide to go with war with Reddit. They chose the dumbest people they could possibly go to war with. Okay, you don't go to war with somebody who has nothing to lose. People on Wall Street bets are playing a game. This is gambling to them. They're using money that they don't mind losing. This was just a meme. This was just a game. And then the next step that happened, as it always happens, the media picked it up, and media picked sides. Some of them are bashing on retail investors. They're saying that, oh, you guys are greedy, you're this, you're that, making bad decisions. Some of them like the underdog story. Some of them said, yeah, down with financial institutions, down with Wall Street, let people trade. And there was a bipartisan thing where Ted Cruz and AOC were like, oh yeah, Robinhood sucks. And so now everybody's talking about it. And now there's even more people trying to find out what's going on. And this is where the story really turns around. This is where I think it really matters. Money goes and it stays. The whole story with the shorting is it doesn't matter what you're doing. The stock market is all just made up. You can pretend to buy and sell, borrow stocks. What really matters is human growth. And I know this is the first time I'm mentioning it, but this is what really makes me passionate about what's happening here. It used to be about the money. It was about the memes. It was about the attendees. And now it's really about people learning about investment. They're learning about these institutions. They're learning about the kind of power that they have. People are going out of their way to learn more about investment. I think I've got another question here. Yeah. If you can go to section 3 of your quiz, slide 7, the question asks, what happens when you're allowed to sell an item but not buy it? If you'll just take a second to answer that, because my throat is dry. And does anybody want to share their answers here? If you're comfortable sharing your answer, what happens if you can sell something but not buy it? What happens to the value of that item?
It should be, if I'm not mistaken, it's blatant market manipulation. There are class action lawsuits filed against Robinhood on the same day that occurred. Because if you were Robinhood and you wanted to be responsible or what have you, you would pause buying and selling on that stock. But sending such a strong signal to the market that some effort, fuckery, for lack of a better word, is afoot. A lot of the stock market in the short term is investor confidence and what the popular media runs with. So when you let that happen, and this was a very conscious decision by Robinhood, obviously. Mm-hmm. it really scares people, especially when GameStop was past $400 a share when they decided to stop trading, not just on Robinhood, but other platforms.
Mm-hmm.
So the share was already at an all-time high, and when you get such a strong signal, I think more than half of Robinhood users have shares in GameStop.
Yes, absolutely.
It really scares people. So if you bought in at $20, $30, anything under 400, and you saw this happen, you're gonna be like, oh, you know what? I'm just gonna cut my losses, take my profits. And that's the signal.
I mean, it was meant to scare everybody. And I'm sorry to cut you off here, but this is something key here. They're doing a lot more than just this. They're trying to scare everybody off of this stock. They're trying to get people to sell it again. And Carmen answers this in the group chat here. She says the supply increases and the value of it goes down. And that was their intended result. That's what they really wanted for to happen. It didn't really happen. If you take a look at the stock, it's kind of sort of flatlined after this whole debacle. And that's where the meme comes from, diamond hands, hold the line, blah, blah, blah. So their intent there was this one technique, the biggest one that everybody hated, but there's also a lot of little things that these guys are doing. On one hand, they are actually also trading the stock even more amongst themselves, amongst the hedge funds, to drive down the value artificially as you look at it on a screen. They're trying to create a difference between the perceived value and the value printed on your app. But again, that doesn't really happen either. So far, Robinhood has shut it down. Wall Street goes to war. And now a lot more people are looking into trading stocks. So what does that really mean for people like us? Well, first off, you can either make some popcorn and watch the drama happen, which is totally okay as well, because don't buy a stock that's $300 with zero value, or you can go ahead and buy and you can participate in something like this. When you go out and you can make your popcorn and you watch and you pay attention, because what's happening here matters. But the ramifications of what happened here afterward also matter. Or you can go ahead and buy in. So if you're going to go ahead and buy in, you own one share of GameStop, that's more than enough. Just go ahead and hold. So let's talk about what happens if you buy in to this environment here. The first thing is Robinhood was an option. It's no longer a viable option for multiple reasons. You need to go out and find the brokers that you can trust. I'm not going to go ahead and shill, American, TD Ameritrade or whatever, Vanguard, Fidelity. You do your research. That's not what I'm here for. You do your research. You'll be more proud of what you accomplish when you do it yourself. Robinhood is gone for multiple reasons. The first one is they did something really, really dumb. They stepped on their own feet and they shouldn't have done anything in the first place, but they did, and they did the worst possible thing. And so for multiple reasons, Robinhood is done. People are going to stop using it because of all the bad publicity, hopefully. Their investors have no money. When people start cashing out these stocks, Robinhood actually has to initially pay them out from their own pocket. They don't have money for that. If you read about it, they raised about $1 billion from their investors because they realized that one day they won't have money to pay everybody back if this squeeze happens. And at the same time, I mean, the big financial institutions are going to stop supporting Robinhood because they're like, hey, you morons let all these, Wall Street Redditors get on board and screw us over. That's one thing. The other thing is, if you're going to buy in, only spend money that you're okay with losing. I mean, specifically with what's happening here, there's a very real possibility that everything goes to zip. There's a very real possibility that you lose every penny you put into this game. Yeah, I'll go into that in a second, but you need to be prepared that even if it's not through some company or whatever screwing us over in some way, or if it's just the stock market doing its thing where people realize, hey, this is a meme, I don't want to do this anymore, and they cash out, there's a very real possibility that GameStop, Nokia, BlackBerry, all these stocks are going to crash hard. No matter what, though, it actually starts to boil down just the principle of it. If you bought a stock, you bought into this message. And so what happens is that you have participated in a situation where you owe one another something. I'm not talking about like owing somebody a stock. I'm talking about owing your fellow person a position in the world where you have value in the stock market as an individual, as a trader. Now it turns into sending a message because these people said, hey, you can't make money like this based on based on their expense. For what? Why not? That's the game. You made a bad trade. You took a risk that you shouldn't have taken. Somebody figured it out and now we're all exploiting it. How can you change the rules of the game like this, especially when we need it so badly? There's people out there who can't pay medical bills, who can't pay for their rent, who didn't buy their children Christmas presents. What kind of message is being sent, and what kind of implications does this have on people's psyches? So if you bought a stock, you hold the stock until, I mean, the end game, really. So if you have one stock, you hold that stock. If you're like, some of those crazy people on Wall Street Bets with hundreds of stocks, they're planning on holding those stocks. And this is where the meme comes from: diamond hands. Don't be paper hands, be diamond hands. Hold strong, hold like diamonds. And let's talk about the end game here. There's a couple of possibilities. Breaks down to just 3 of them. First one is the squeeze. This is the meme everybody is trying to run for. The meme is the stock will keep going higher and higher as long as they don't play any more games with us. It'll go high, high, high. You'll be able to sell it for $1,000, $10,000. There's these people who are saying as soon as it hits $69,000, $69,420, I'll sell. Some people, there's games that people are playing. It's still a game. It's still a meme for some of these people, but it's also about the principle. So squeeze can happen. You could have an infinite squeeze. It's some, possibility. I don't know. Nobody knows. That's the hope. As long as you hold, it'll hold. In my opinion, the most likely scenario is a flat line of the stock where it just follows market trends at that point, or people start valuing GameStop for the actual company that it is or the direction it's going in. Essentially, it holds between $300 and $400, which it's reasonable. And these hedge funds who shorted the stock die a very slow, painful death. They bleed out over some period of time where they restructure their debt, they restructure these contracts, and they're able to buy it back in piecemeal rather than having to buy it back right away at the one cutoff. Now the cutoff wasn't a hard cutoff, as you knew, as the stock didn't squeeze on Friday. It may not squeeze Monday, it may not squeeze next Friday, and that's a very real possibility. At some point, the stock will flatline, the meme will die, and people will start moving on to something else. Then there's a third possibility, and the third possibility is the most dangerous one, but it's also one that's not out of the ballpark yet, and it's something that you have to confront as a possibility that this is something that can happen to your money, to your stock. And the possibility of that is it just goes away. Any combination of things can happen. The government can step in and turn their backs on us again and say, hey, all this stuff that you did, it doesn't matter. Robinhood just, goes under, they bankrupt, they say that they can't pay back your stock, blah, 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 it vanishes into thin air. GameStop as a company folds because they get bribed and they just, whatever. There's 1,001 things that could happen. It doesn't matter what can happen. This is a real possibility that if you're going to buy into GameStop, you have to confront it with being okay. Goes back to, if you put in any amount of money, be okay with it being gone forever. As Thursday showed, these people don't care about the laws. They'll just break anything they can just to keep their money in their own pockets because they just know they're going to pay off the government whatever later on. Or the government will just be too inept to go after them afterwards. So after all this, no matter what real possibility it is, everything is going to change. I think I've got another question here because it just kind of leads into it. Nope. I've got another question. Yes, I do. Okay, go ahead and go to section 4, slide 9, and answer these 2 questions in the quiz. And then if you're comfortable sharing, can you also answer on the Zoom or in the chat? Would you spend the $350 on a stock knowing you can lose it all? I'm not making any judgments. If you spent that money, you spent that money. I think you made a decision and you stick by that decision, and we support your decision. And if the answer is no, then it's no. But yeah,
I'm just doing this for fun.
Did anybody else actually buy stocks? I'm just curious.
Wesley did. Wesley has 1 share.
Nice.
You got it higher than I did.
I hope he earns back his
GME.
Like, I'm happy if I make like $50 off this or something.
Right. And I mean, that $50 makes you happy. And I think that's kind of the point, right? If $50 makes somebody happy, then let people be happy, even if it means that a financial holding company dies. Now, what changes in my opinion is that people, I think you can still see my screen, so I'm just gonna let you read it. Everything is gonna change. I mean, if there was a bigger turnout, we'd have a bigger population size, but like how many people in just the past week have gone out and bought one of these meme stocks? How many people went out of their way to find out more about what's going on in the world? Look at the Google search trends in just the past couple of days. You know, between last Sunday and this Sunday, the amount of financial information in the collective human consciousness has grown exponentially. And what happens next is that people keep buying stocks. They realize that the barrier is not so high, because I'm telling you, it really isn't. And the more you learn about this stuff, the more you take charge of your finances, and you keep going to events like Spread, and you learn more about what's going on there. You do your research. Like I said, I'm not going to tell you who to go to next. Don't go to Robinhood, but go to somebody else. Do it yourself. People are going to follow this trend. They're going to keep this in the forefront of their minds. And people who have $300 sitting around, rather than spending it on a PlayStation, they may bet it on something in the stock market. In my opinion, this is the most important thing that's come out of this whole drama. The meme turned into something that changed the world. People are learning about the stock market. They're learning about financials. You all know now about shorts and longs that you didn't know about before. So here's a bit of advice. How do you navigate the financial world after the meme? Get good. Find some reputable data sources. Don't look for opinion pieces. Wall Street Journal is great to keep an eye on the other guy. But you go and find yourself some sources that tell you actual numbers, that actually do in-depth, unbiased research into things and people. Sorry, I was reading a chat thing. Do your own research and find reputable sources. Decide on a portfolio type. If you're going to go long term, there's portfolios out there that have been tried and tested over the past 10, 15, 20 years that you can also imitate. I've actually got some links in my presentation here for what I use to research my portfolios, what I want to go with. Diversify your risks. That's important as well. The whole GameStop thing only works because there are people who said, hey, I have $300 sitting around that I wasn't using for gas or rent or retirement. So they diversify this risk. And so if you're okay with losing that amount of money, you've actually already sort of, you may be a natural at Wall Street bets and you don't care, or B, you did diversify your risks. So in my opinion, in my situation, I have 4 GameStop stocks that I was okay with spending my money after. I said, hey, it's not making money elsewhere. I'm going to shift my thing and I'm going to let this be a thing. Let my investment come from somewhere else. And then contribute regularly. That's just a thing. I mean, if you have $10 and it's giving you 2% back a year, that's nothing really. But if you put in $10 a week over and over again, it compounds on its own. So that's what you do from this point on. I had one more question. Yeah, let's go to the last question there for slide 11. It says, is GameStop an investment? Is it a message? Or is it just a waste of time? I'm actually curious about this, so I'd appreciate it if you answer this last question. And we can also discuss it in the chat or if you're comfortable talking about it. What do you think? Is this a meme? Is it an investment or something that I didn't say?
Yeah, at this point, it is definitely not an investment. This stock is so volatile, most people should stay away. Only if you want to gamble, have fun, and send a message. Consider this money, especially if you don't have an exit strategy, whether or not the squeeze occurs. If you don't have an exit strategy, then consider your money gone, because GameStop is not clearly worth the current value. And it will go back down. It's just a matter of time.
I don't have a share, but I think it's interesting to kind of follow it just because everyone else is following it and it's such a big deal. But I think, for me, it's about sending a message, and I hope people who have a share just hold it, because it's kind of not fair. Like, we all know that like Wall Street is making all these trades, and they're making money off of it, just off of trading. It's not like the value isn't, they're not making anything or creating more value. I would just say they're just trading to trade and make money off of like expense ratios and whatever. But I learned a lot out of this. I actually watched a video on YouTube from the Reddit guy. Forgot what his name, Deep something.
Yeah,
but he goes in on, deep effing value. And he goes in on a whole analysis on his YouTube channel about why he chose GameStop. And as someone who's not financially savvy about how to pick a stock, how to pick an individual stock, the YouTube channel or that YouTube video gave me a realistic idea of like, what do I have to do if I really want to pick stocks? Yeah. Like I'd have to do a lot of research. I'd have to look at financial statements. I'd have to kind of forecast myself based on those numbers and based on my knowledge on press releases and stuff. Yeah. So I think for me, it was like a learning experience.
But see, that's the thing though, right? There's somebody who can pay attention to all the little nitty-gritty details of a company and then, throw out the information in the world on a platform like Reddit. And people can pick up on that. There's nothing inherently wrong with that. Some people put in their due diligence to an extreme. And for some of us, just this discussion is enough to understand whether or not you want to invest into GameStop or something like that. And I think that was just really the core of this idea here. That what started off as a meme, that was just a game, turned into them freaking out and trying to change the games of the rule when we started winning. And that just turned into a movement where I realized that a lot of people are going to be paying attention to what's happening, and they're learning, they're learning, and people are going to be doing things in a different way. And I'm hoping that the stock market changes entirely. The more players you have, the more, not like exploiting their mistakes and make money off of their bad bets, but like, it just makes sense if everybody's paying attention to the world and the resources available to us. I think that this is one of the most important things that for young adults in our lifetimes who are interested in trading for to have happened. That's it for my presentation. Does anybody have any questions? Anything I can go over again? Obviously nothing. I gave an amazing presentation. Thank you, thank you, thank you.
Yeah, so we could just move it to maybe a general discussion now, if anyone has any thoughts.
Most things, this is just super entertaining.
Yeah, definitely. A lot of entertainment value. Some of these memes have kept me up all night because we're just so, they're so damn good.
Yeah. I would add that I don't expect anything to change fundamentally about the market. If these couple of funds go under, I don't know what the chances are, but whether or not these funds go under, there's going to be other hedge funds that will come take their place. The incentives in the market are, entirely the same until there's any political movement. And so you should always keep your wits about you, especially since the pandemic. Literally everyone's made money on the stock market in the last year alone. So, and that's not necessarily normal. So everyone's made money off the stock market, but don't think that it's a guaranteed thing if you're playing individual stocks like GameStop and what have you. You should still, diversify and invest regularly. But don't think that everything that Wall Street Bet says is going to be a sure thing from now on.
I am linking my presentation. Oh, what did I do? Turn off my video. My presentation in the chat. How do you do this? I turn off my video again. Ridiculous. I have some of my own research in the comments of that. Some links to some websites that I used that are referred to do my own research that I suggest everybody else look at as well. Just even if you open up the site and you look at it and say, that's nice. That's something that you've done to make yourself a more invested, a more savvy, more intelligent investors. Yeah, Carmen, good question. What kind of regulation do you want, or do you think could happen? That's a good one. I'm gonna start calling out people.
Sarah's like, yep, I'm gonna dip if you're gonna call on me. Bye, Sarah.
See you later. So, I mean, you know, Stephen made a good point. The stock market's been trading at a very unnormal rate. I mean, some people argue we're in a bubble, it's going to crash, this, that. It's all artificially inflated. And this really just outlines that everything out there is just a game. You could choose to play it, or you could choose not to play it. And I mean, you know, what the government can do or shouldn't do, I mean, their track record for the last 25 years has been really crappy. Every time there's been a big thing, they always they always made the wrong legislation, the wrong laws put into place. When 9/11 happened, they introduced the Patriot Act, and now all of our information is just out there with the government to do what with. You know, in fact, this isn't even the first big financial upheaval. At one point, they said that people like you and I, who have less than $25, excuse me, less than $25,000 in our trading accounts, can't day trade, which means that if we have less than $25,000, we can't just buy a stock at market opening at a low price and then sell it an hour before the market closes at a bit higher price. I mean, if you look at that volatility there, if I could have bought that GameStop stock at a low price on Monday morning and then sold it at a bit higher price if my portfolio was too small. And it just kind of screws over very explicitly the small people. And so as much as we'd like for there to be good legislation, there's a possibility that it could actually, you know, regulate us out of the stock market entirely. Yeah, I mean, I'm not specifically on maybe the day trading laws there, but 1 day trade every 3 days seems about right. And so at this point, let me ask you guys: are you planning? Go ahead, Stephen.
I was say Carmen mentioned she watched the Deep Effing Values YouTube channel, which, by the way, I think he goes by Roaring Kitty on YouTube.
Mm-hmm.
He outlined, you know, studies he did for GameStop to position himself. His analysis is obviously it was sound. He saw the short interest, and he saw the amount of money that GameStop as a company still had in their books, and his name is Deep Effing Value because he's a value investor following the footsteps of Warren Buffett. Basically, just finds companies that are undervalued and invest in them. Now, when he made his calls, he would have had no idea that this would blow up like it did. So all he thought was that this company is undervalued. It will still be around in the next few years with some type of revenue, and so he made his bets. But not if first of all, there's that bridge there's that barrier that we individual investors have to cross, whether we want to put in that much work, which the answer is probably not. But not only that, the reason why I say the game has not fundamentally changed is because the way that Robinhood makes money without charging us, the investors, is by selling the data on our trades. So they take the patterns of how we're trading. They also take your for example, your sell orders on Robinhood. When you say make an automatic sell it when it hits 420.69, they have all that data, and they sell it to the hedge funds. That's the connection between Citadel and Robinhood. Citadel is Robinhood's #1 customer for that data. And so basically what they have is a step ahead of you. And they strategize based on how retail traders are investing. And that's why it's, you're always at a disadvantage when you're a retail investor. And so just keep that in mind. Yeah, keep that in mind, guys.
Yeah,
that's a good point. I've heard like a lot of these hedge funds, like they employ a lot of like automated trading. When it comes to day trading, they use a lot of automated systems. And And their main competitors are really just other hedge funds, right? When it comes to buying and selling individual stocks. So I've heard that like there was a lot of, you know, blood, sweat, and money that was put into getting their computers to literally be closer to the trading floor so that they could make their trades like physically faster. It would have to like their electrical signals would travel over less wiring and stuff like that. So it gets really intense, you know, when it comes to day trading, especially. So you really have to watch out because the people who are really making large amounts of money off of it have the infrastructure to compete on a scale that is somewhat unimaginable. Mm-hmm. So that's why they're kind of upset about this whole thing, because it kind of came out of nowhere from their perspective. I do want to like caution that this looks like a speculative bubble right now. Mm-hmm. The stock price of GameStop. If you were in on the ground floor, like what, a week and a half ago, then you would have made money. But I feel like right now, if you're just chasing good money after bad right now, that would be my advice. Yeah, a lot of hype.
I want to get to Lucy's question, but just to counterpoint William here, I mean, you could just say that it's speculative and you could just shy away and play it safe. And like Steven says, this might just be a bad investment. Or it's a really good idea. Think about it. If the more of us are buying these stocks now, we're driving up the price anyways. And then when the time comes for these guys to have to close out their positions, these big oil hedge funds, whether or not they'll die and come back in a different company, they have to pay us somehow, some way. Somebody's going to make money. Whether or not you think you're going to be the one to make that money is almost irrelevant, because you're participating in this event anyways. If you go into this transaction, like I said, knowing that you might just lose it all, you have nothing to lose to begin with. It might just be a good financial decision, because if you're hoping for a 0% return and you get a positive one, that's an overall win. Now, Lucy asks, if hedge funds did go bankrupt, what would be the effect, if any, on the overall economy? Yeah, basically almost, in an individual company, if it goes under, not so much. There's a domino effect that could go into place here where these companies go bankrupt and the people who are popping them up go bankrupt, blah, blah, blah. And on the other hand, you can also say that, they'll just, declare bankruptcy like Michael Scott and pretend it'll go away and they'll come back in a different company, which is something that could happen. These people are funding it basically no effect in as of itself as a company that dies. But there is an effect later on, like I said, in the perception of people, where you and I are deciding to start trading a little bit, even if it's not buying into a meme stock like GameStop. You're still paying attention. You're still trying to trade. You're selling your information to Robinhood, but then you can choose somebody else to sell your information to later on. So just specifically the idea of some of these companies going under isn't so big. They'll just buy out their algorithms, they'll buy out the infrastructure and sell it to somebody who's going to keep doing it. Essentially, it won't change unless the law steps in.
I don't know. I've always felt that our current capitalist system is fundamentally unstable, and it really only takes one or two shocks, one or two catalyst events to really sort of tip things over, I mean, does anybody know exactly how the subprime mortgage crisis happened? I mean, there was a lot of sort of financial obfuscation that was happening, and so a lot of people were chasing good money after bad,
right?
And things just sort of, there was a domino effect, right? Where there were these, what happened from what I know of is that there was this implicit understanding that the real estate market, the value of any house, any apartment building would go up forever, indefinitely. If you bought a house, the value always had gone up, therefore it always will go up. So that sort of was the fundamental understanding amongst everybody involved, right? So you start with that, and then you have another fundamental idea, which is owning a house means that you're a cool guy or gal. It means that you're cool. It means you are a part of the American dream. So you have a lot of people who want to buy houses, right? And you also have banks that want to make money off of the people who want to buy houses. So they're willing to lend you money in the form of a mortgage, right? But typically a bank has to assess whether or not you're going to pay back that mortgage, right? How risky you are as an investment. You as the person who want to buy a house are the investment for the bank, right? They have to decide whether or not the money that they're going to give you to buy that house, whether or not they're going to pay you back, whether or not they're going to pay back the bank. So the banks, like, they just kept lending money to like shadier and shadier people, or people who, you know, were probably stand-up people, but they just would not be able to afford a house. But they were lending out to more and more, quote unquote, subprime mortgages, right? There were the prime mortgages, money that was given to people who were definitely going to pay it back. And then there are the subprime mortgages, money that was given to people who were maybe could not afford to pay it back in no conceivable way. You know, they were just intending to buy a house, have the money go, the value of the house go up, and then sell it so that they could pay back their loan, right? And then inevitably, if the value of the housing market dips at all, then that strategy kind of blows up, right? Another thing that was going on is like, you know, mortgages were getting like, subprime mortgages were getting packaged with other mortgages into these weird, ludicrously complicated derivatives. So it was really hard for regulators and third-party watchdog groups to understand what the hell was going on, right? So there's all this happening all at once. So if you have a little tiny dip, then that could set off a chain reaction, right? So the question I think when it comes to GameStop is like, are there other sort of landmines, do you think, in the wider stock market? Do you think that there are like a lot of weird financial derivatives that are bundled up with maybe some of these short contracts? Like, what is in all of these contracts and how are they all bundled together? Or are they bundled together? Like, you know, when these hedge funds go under, like, who is affected? And it could be really bad. You know, the 2007, 2008 financial recession was really bad. And it started, well, it wasn't like caused by a war or a nuclear bomb going off. It was caused by a tiny dip in the housing market, which caused this huge chain reaction. So I feel like, you know, you always have to watch out for these bubbles. And I do think that GameStop stock is a bubble, regardless of good intentions. And I do believe in the good intentions. It's great, you know, Wall Street guys are assholes. You got to stick it to them. But, you know, to what end, you know?
I mean, you make a good point.
Yeah, I would. So I would also make the case to Lucy's question that this could trigger the next bear market, which is, you know, the next period of a down market, because the theory behind the squeeze is sound, where there's not enough people selling shares, and the contract holders, they either have to keep paying their interest or buy shares at incredible prices. That theory is sound. The concern is that if it does occur and those share prices really skyrocket, and sooner or later the contract holders, they're gonna have to be on the hook for those. They can just say, screw it, we're not paying the interest anymore. We'll just cut our losses here, and we'll pay what the asking price is for shares. They can do that, but actually, if you say there's like 6 main hedge funds that hold millions of these short contracts, that, I don't know the details of a prisoner's dilemma, but between those 6 hedge funds, that is actually their own dilemma, because once the first hedge says, screw it, we're going to close our positions here, we're going to buy all the shares at the current asking price, that will instantaneously, given the amount of contracts they're holding, that will instantaneously skyrocket the price of shares, causing perhaps the next hedge fund to say, oh my God, these shares are just going straight up, we got to get out right now as well. And then so on and so forth. But in order to do that, in order to avoid bankruptcy, it would trigger perhaps a mass sell-off of their other holdings in order to have the capital to buy GameStop shares. So if they're holding maybe, you know, like 100,000, 300,000 Apple shares. Oh, sorry. Is this still okay, or should I? Let me get out my headphones. But basically, the hedge funds might have to sell, and not just the hedge funds. The hedge funds can go under, but their but whoever lent them the money or whoever is their parent corporation, they're still going to be on the hook to execute those contracts. When you declare bankruptcy, you don't just get off scot-free and you don't owe any debt anymore. Those contracts still have, so what could happen is, in order to pay for GameStop shares, they might have to sell all their other assets of Facebook, Apple, Tesla, and what have you. And once you see all sorts of red in the market, normal investors, they're relatively simple. They want to protect their gains, so they would also sell to try to, stay high. And the stock market is very finicky. I know there's many times in history where panics happen and the stock market tanks. Just look at history. So that is one way things could go. And that's one way that even one hedge fund going under can affect the whole market for years to come.
Yeah, and like bouncing off of that, it's like when it comes to a run on stocks or a run on the banks or a panic, when something like that happens, a mass sell-off event, the people who end up recouping the most of their losses are the people who can sell first. And like, who is in a position to be able to sell first? Is it going to be the random, penny stock investor who has an inconsistent internet connection? Or is it going to be the Wall Street investor who has their trading computers like right next to the trading floor? I don't know. It's like, I feel like they're at a huge advantage regardless, So you have to watch out for that. You got to make sure you're not left holding the bag, you're not left holding all these stocks that are essentially worthless and the value is only dropping, So you have to be very, very conscious of that. And I think that's why you need to have like an exit strategy. I feel like it would be good to have a date in mind if you're going to buy this stock, a date in mind as to when you're going to sell it, I don't know. Or at what price you're going to sell it at. I don't know.
Henry asked a good question. Can Wall Street collaborating be labeled as market manipulation? Does anybody else want to answer this question? Because this is a really good question. In case Will or Steven or somebody else knows.
It depends what your goal is. Like, if you're like, has the government ever acted on these folks and prosecuted them? Well, according to the Obama administration, the folks that were responsible for the 2008 crisis, they weren't breaking any laws, technically, right? And so they studied the matter, and whether or not you were a fan of Obama, his administration, apparently they found that they didn't break technically any laws that were on the books. And so according to Obama, they made some laws that were apparently like repealed later on by Trump, what have you. But to answer your question in that way, I guess the government didn't consider that illegal, even though I'm sure explicit market manipulation is illegal.
Yeah, I think there are laws on the books, but it's whether or not the current administration is going to enact or execute those laws. Like, they're the executive branch. It's their responsibility to pursue that. Yeah, I mean, the Obama administration, definitely, they didn't want to appear to be vindictive, right?
Well, I mean, I just want to mention
was always walking on eggshells.
That you guys are talking about whether or not the government will go after these people as a question whether or not the federal government will enforce these laws. I'm talking theoretically, though. Can the government go after these people for market manipulation? There's actually two questions buried here. The first one is what happened with Wall Street Bets market manipulation? And the answer strictly is no. It really is not the quote unquote definition legally of market manipulation. It literally is just one guy saying, hey, this is a good decision for you to make to a certain point. And then other people taking this decision and running with it really, really fast to the point that even the guy who started the movie is like, hey, I didn't mean it like that, man, but this is good too. It wasn't initially supposed to be manipulating the stock or market, whatever. It was really just capitalizing on a capitalistic thing that you could have made money off of. So technically it's not manipulation. Second off, whether or not this government can go after people, I actually also think that they can't. I mean, whether or not they change the definition on us to go after us just to fuck with us, can they go after us? No, there's millions of people on that Reddit. Even if they spend the money to track us all down individually, did we break any laws here? Technically, again, did we? I mean, logically, did we? And again, I'll say no, not only because I own a stock, but just because, I don't think we did. Will, you got your mic on. Did you want to say something?
No. I don't. Well, I guess adding to what you just said, I don't think they're going to go after retail traders, right? The question is whether or not they're going to, I don't know, go after other people. Or I just don't think they're going to go after anybody. The stance of the SEC has always been sort of like, hey man, that's the market, man. Just let them do what they do, dog.
And not to mention, I think Ben Bernanke, who was part of Obama's administration, is a senior advisor on Citadel's board or something like that. Let me look it up.
Yeah, wasn't Ben Bernanke around during the Bush administration? I think he was the guy who made the transition because things were so weird that they kept him on. I don't know.
I don't know.
Not to mention the current Treasury Secretary, Janet Yellen, apparently has received $850,000 in fees from Citadel for her advice as well.
I just want to kind of argue
cool.
there that, not just to defend not just to knee-jerk defend Democrats, but I think that Yellen got that money from speeches and appearances, which I think as a public personality with any sort of value, go for it, make your money no matter who you're going to, because you're just offering your own advice. If you guys all paid me $5 to do it, I would do it anyways. You know what I mean? The spread, it just makes sense. I don't know if she's biased or anything like that. So there's two sides of it. This just goes back to do your own research. We got about 7 minutes left. Anybody else have any other questions? Any points?
Yeah, $850,000, bro. That's friggin' some life-changing money, dude. You would be able to hold your principles if someone gave you $850,000?
Bro, it's chump change.
Probably would affect you subconsciously.
$850,000 is nothing to these people.
No, I mean to a public servant like Janet Yellen.
But even it's just Obama advice, isn't it? If I was offered a $850,000, I'd be like, okay, I'll give the talk. I'll take the money.
Yeah, you don't think that'll affect
she can just talk. If we we're very clear that this transaction it's just because I'm giving the talk, not because of anything else. I would take the money.
Even if you had all that, I would make the case that subconsciously you would treat that person a little more, nicer.
That's true. There's probably some undue influence, but on the other hand, it's all of her actions are in the spotlight. So she has to weigh whatever it is she's going to do in regards to how it's going to be perceived in light of the fact that she took that money, right? And I don't know. She's always struck me as more of a technocratic operator, not necessarily partisan in her decision-making.
Well, $850,000 is not partisan at all, man. That's straight cash, bro.
It's true, but she also said she would give up all those assets, if she were to be nominated for the position that she inevitably was nominated for. That's how those disclosures were made. Otherwise, she would have just been given that money and nobody would know about it, right?
Right.
I mean, the 850 would still be hers. She could liquidate those assets. She wouldn't give that money away or give it back to Citadel.
Yeah.
Straight in the books. I would not be surprised if the government acted and intervened, because the theory is sound that the share price can go to the moon. But obviously, practical matters. If it does, that would cause some extremely big problems. So I wouldn't be surprised if the government intervened a little less to the favor of the retail investors and a little more to making sure shit doesn't break and we can keep going on at least as normal, even though
I agree. Work. I feel like the government is invested in continuing the status quo, especially during a pandemic. It's we need a financial crisis on top of that, and I think they perceive this as a financial crisis if it goes south, or if it goes to the moon, they would perceive that as a huge bubble. But I don't think they would like track down retail investors and like throw them in jail or anything like that, right?
So it just so turns out that the best course of action for almost every party involved is to just sit there and do nothing and wait for somebody else to draw first. But
not for the hedge funds.
Well, right, with the exception of the hedge funds, in which case they have to short out their positions at one point.
Yeah, man. Our balls are in their court.
The government might have to bail out the hedge fund. I don't think they have any reason to. I mean, other than the concept of too big to fail or some shady.
I mean, if they're really worried about the market going south, they might have to resort to that. Big maybe.
Big maybe, yes. Because I don't think these hedge funds are like large enough to comprise a significant portion of the. Plus, it just looks bad bailing out like these hedge funds.
Yeah, it's just it's like it's a possibility. I'm not saying it's a high one, but like if like a big fat chain reaction did start happening, they might step in like that.
It was bad enough that they bailed out the banks way back during the financial crisis, but it was like some people do, most people do interact with those banks in some form that is not.
I don't think it's gonna get to that way, but this is like the worst possible case scenario. I'm saying if it gets that bad, which I don't think it will.
Well, I mean, if things start to go bad and the dominoes start to fall, the hedge funds are the first ones out. The government wouldn't bail them out. They would bail out somebody a little bit further down the line to stop the chain reaction to going so far as toppling the U.S. economy. They would probably bail out the banks or the holding companies or something like that, rather than just the hedge funds. The hedge funds can fall and come back again. Something further down the line that's going to break. The government has time to step in and help, but also has more of an interest in helping in the first place. Which is why it's a big maybe that the government is going to step in at any point to bail out the hedge funds. They're just gone, unless they can sort of raise funds amongst themselves to keep themselves going, or they do some other games to play in the stock market using their big brains and their big degrees. It's unlikely that the government will bail them out. Carmen, we got about 2 minutes. Do you want to take over from here?
Okay. So I hope everyone enjoyed Hari's presentation. Hari, I really enjoyed it just because while I do follow what's going on, I'm not like seeing the whole picture. So your presentation really helped me gain that clarity. So thank you for that. And I hope everyone else enjoyed the presentation and the discussion as well. Feel free to reach out to Hari or me if you have any questions, or if you want to do something similar, or if you have a topic in mind. But enjoy your Sunday, and we'll talk later.
Thanks for coming, everybody.
Thank you, Hari.
Anytime, Will.
It was cool.
We'll be posting the video and resources, so be on the lookout for that.
It's almost as good as a cheesesteak. Not quite, but you're getting there.
No, you're wrong. You got the wrong sandwich obsession. It's actually the hoagie that's Philly special.
The hoagie is bogey. It's bogus. It's the hoagie's lame. It's all about the cheesesteak. I think next presentation should be on how to make a cheesesteak. I think it's obvious. It's the natural.
I think you should do that one. The only person it's obvious to is you.
No, yeah. I mean, I can be involved in like the end, like where
eating it.
There's like a judge at the end, and I give like a 1 scale. Like, is it good or is it like not steak? Is it like, you know what I mean?
I like to be on that panel.
I don't know what you mean. I just have to come to your spread, I guess.
Yeah, you gotta spread the cheesesteak,
Hey, Bella, Will, I think you still have my number. Hit me up. I wanted to talk about the stuff you shared with me last time. It was really, really good.
Yeah.
It was so good.
Yeah, I can text you.
Please. It was the only thing in the longest time that's kept my attention for that long. It was good stuff, man.
Yeah, I mean, if you have any comments about it, you could like leave them there. I think you can leave comments in the
I didn't think I needed to, so I never checked. It was really good.
Oh, okay, cool. Yeah.
All right. Bye, Carmen. I'll be the last one out, just to turn off the lights. What if like Natalie and Lucy were just like AFK the entire time and they're like not even paying attention, so that's why they're not leaving? Or you're here to hang out and talk to me.
No, I'm here. Just don't really want to be recorded the whole time if I'm just staring at my monitor.
Oh, hang on one second.